Thank you everyone for joining us for the last presentation of the day. I hope it's been an informative and interesting conference for sure. My name is Winnie Caesar. I'm the Global Head of Strategy at CreditSights, and today I have two of my favorite colleagues with me to discuss all things private credit. I have Zach Griffiths, who is our head of U.S. investment grade and macro strategy, and Andrew Headland, a reporter and managing editor at LevFin Insights, which is one of our CreditSights sister companies. Andrew is truly an expert on all things BDCs and private credit and gets the inside scoop from a number of industry sources. Now, today we are trying to figure out whether we are witnessing a turning point in private credit. We've seen a lot of headlines lately and a lot of worry about a potential problem starting to emerge. Or alternatively, is this just a healthy correction? On that note, if you have any questions that you would like to ask us during the presentation, you are feel free to submit those using the Zoom webinar Q&A function, and we will be addressing those as they come in. All right, so let's get right into it. And Andrew, in one of your recent reports, you wrote that facing scrutiny from the First Brands and Tricolor fallout, headlines of cockroaches, and now market jitters around AI and software, the golden age of private credit is indeed past. So let's go ahead, let's turn back the clock a bit and set some context. What exactly made the golden age of private credit so golden?
Hello, everybody, and thank you, Winnie. So the golden age of private credit really was probably from 2021 to 2023. 2021, obviously, the deal machine was humming. There were just so many different buyout transactions, refinancings, recaps that, everybody was just printing, money basically. In 2022 and 2023, when the Ukraine war and the regional bank crisis occurred, private credit funds were largely the only game in town, or at least one of the most viable funding sources that left them in a place where they could charge higher spreads and get lower leverage. So you were getting decent terms. Whether you thought the risk reward was there is another question, but on just a straight terms basis, you were getting some really attractive deals, and then the retail capital flood, which is something we'll talk about later. That has grown a lot in the past couple of years, and those that golden age was, something that made it really attractive to non-retail investor. I'm sorry, to non-institutional investors.
Yeah, absolutely. That hunt for yield, I think, cannot be underappreciated as we are discussing private credit and the amount of capital that came into the asset class. So, Zach, I want to go to you as the market is really working to understand whether there are cracks in the private credit market, which, if we are dealing with credit markets, there's oftentimes losses. There are oftentimes defaults. That's just kind of how markets work. You underwrite to the best of your knowledge and ability, and sometimes things go a little bit wrong. And portfolio diversification and allocations should mitigate some of those losses. But then there is this fear that given how much the market has grown over the past, call it decade, that there's a true systemic crisis looming as the linkages between public and private credit become more significant and the amount of capital that is being lent out has become much more significant. Can you walk us through some of the recent events and why the market is so worried right now?
Yeah, thanks, Winnie. It seemed to start with First Brands and Tricolor at the end of last year. Both of those appear to be due to fraud, and so not necessarily a symptom of weakness throughout the private credit ecosystem. I think there are some signs. As you can see here, we certainly have seen defaults go up, and we can talk about that a little bit more. But I'd say that the opaque financing structure of those two names and the extensive use of off-balance sheet financing is somewhat unique. I will say it's interesting to consider some of that in the context of the recent investment grade private credit, where you're seeing a growing use of off-balance sheet financing to finance things like data centers. So I think there are some recurring themes across the market that is causing a bit of consternation, and maybe some of it is justified. It does seem like the media narrative to some extent is probably a little bit more intense than the reality, at least focusing on some of these specific names that do seem to have some pretty clear idiosyncratic factors to them.
Yeah, I think that the really interesting thing about First Brands and Tricolor is it highlighted potential cockroaches in private credit, but they weren't even private credit deals. It was, those were mostly broadly syndicated loan deals. I realize that some of the BDCs also own them, but it's been kind of astounding to me that there's this kind of perception of direct linkage, or, perhaps it's just that those are examples that remove some of the very opaqueness of the private credit markets, as, people don't necessarily have a good handle of what is in different portfolios. So let's talk a little bit about one of the sectors that has been very much in focus lately, which is software. We did a webinar on the software sector about a month ago in conjunction with Covenant Review and LevFin Insights, because there is a lot of software exposure both in the broadly syndicated loan space, but also within private credit portfolios. So I'm wondering, Zach, is this worry based on actual defaults that have been realized over the past year or so in either private markets or even public markets?
Short answer is no, Winnie. And so on the prior slide, I glossed over it, but you could see the privately monitored ratings portfolio from Fitch, which is one portion of our overall private credit default rate calculation. That did rise to 9.2% in 2025. That compares to just 4.7% for the broadly syndicated loan market and just 2.4% for the high yield bond market. So this chart on the left kind of shows a pretty clear trend in terms of rising defaults in private credit, a little bit less consistent, I'd say, for high yield bonds and leveraged loans. But thinking about software and tech, is that really a fundamentally driven concern for these markets? And you can see we have a technology software subcomponent in these portfolios that we track with our colleagues in Fitch Ratings, and you can see clearly not. Those are not the problem children in terms of defaults by sector. And so just to put some firm numbers around it, our private credit default rate overall combines this privately monitored ratings portfolio and the model-based credit opinions portfolio. For private credit overall, it's 2.5% for that tech software sector. So none of that is in the privately monitored ratings portfolio, and 3.1% for the model-based credit opinions portfolio. I just went through the default rates for the PMR and a couple of the public markets, but the overall private credit market default rate is 5.6%. So the problems aren't fundamental. I think it's fairly driven around sentiment and a calling into question what these models look like going forward. I think historically a lot of these software companies have been able to push price without a problem. That is clearly over. And I think there's a reconsidering of what the terminal value of these businesses are over the next couple of years, certainly over the next 3 to 5 years as a result of AI. Now, I think this slide is also helpful in considering these various portfolios that we have and sort of the difference in default rate perspective. You can see that cable and tech hardware, interestingly, are among the highest. And then we also have broadcasting and media. It's kind of a legacy challenged sector that seems to be, at least to some extent, coming through the other side. So it's interesting to see all the focus on software. Winnie, I liked your point about some of these deals that brought BDCs into the focal point when those deals were not that heavily in BDCs at all. But I will say certainly plenty of exposure to the BDCs, to the software sector. So perhaps some of the challenging performance in that space makes a little bit more sense in the recent context and maybe was a little bit overdone at the end of 2025.
Yeah, I think that bringing up the BDCs is a good transition, because one of the things that I'm observing is on the financial news every day, the media narrative around BDCs has really shifted. It used to be that BDCs were the thing that would democratize alternative investments, kind of open up alts to the everyday investor versus just the institutional investors who are benefiting from these strong performance track records within private asset classes. And now all of a sudden, it's a much more sinister asset class. So, Andrew, how exactly did we get here with regards to BDCs? How did we go from these are the best things ever to, oh my gosh, it's going to take down regular man portfolios?
Sure. So, if we turn back to Tricolor and First Brands, that created some negative sentiment around private credit. Jamie Dimon's cockroaches remark, these are putting the asset class under even more scrutiny than it had been before. And that's when the redemption started. You saw them sort of tick up in Q4 of 25, so last year, last quarter of last year. And now you're starting to see the headlines come through in a even more negative circumstance. Whether you think they're warranted or not is another topic, but there's a lot of what's the right word? A lot of concern around the AI and software, and to sort of re-emphasize what Zach was saying, you have these companies that are reasonably well off financially, at least coming into this bit of volatility. The idea and the question mainly is around what is their future value, like Zach said, and so that's going to be really hard to, assure investors, yeah, our product's going to be great 3 years from now. Like, okay, you don't know that. So you have to make your best guess, right, about how these companies will perform. And that's been one of the things that's been really driving the BDC narrative, the bearish view on these funds. Whether, it's good or bad, you can make the case for both. It's bad, these people aren't allowed to get their money back or all that they want, or it's good in that these vehicles are working as they should. They're protecting the shareholders, and the manager isn't having to have forced sales on the assets. So the sign of stress on the credit front, it's kind of there. It'll probably get worse before it gets better. And the equity performance among the private credit publicly traded BDCs has been, quite at a discount to NAV. So all of that is, to just wrap up the point that while retail is not the largest part of the private credit investor base, the idea that they were going to go into 401ks was a huge growth point for these asset managers, something they anticipated, but we'll see how the retail sentiment plays out, after this episode is over.
Yeah, and Andrew, I think that your point around BDC investors, retail not being kind of the largest, it's very similar to, say, the high yield bond market, where you have ETFs and mutual funds, which are kind of a retail proxy. And sometimes it becomes this vicious cycle of retail gets scared around recession risk, around default fears. And when they start selling, when we start seeing those fund flows going out the door, it can very often result in some broad-based challenges, even if institutional investors are a little bit more willing to stay the course. And so I think you have to be willing to appreciate that while retail investors might not necessarily be a large portion of an investment universe, they really can be a significant factor as it relates to liquidity, to fund flows, and to kind of credit conditions tightening up a little bit. So, Zach, we have one question from the audience on the privately monitored portfolio and the model-based credit opinion default rates. How do those differ from the private credit default rate? It's two different default rates that are blended into one aggregate default rate, right?
That's right. Yeah. So I actually was just looking at this before the call. I closed it out. I mean, I think there's about 300 issuers in the privately monitored ratings portfolio, another 1,100 in the model-based credit opinions portfolio. And we kind of just add those up. That makes the whole private credit universe, and then the unique number of defaulters in each over that total number. That's it. So it's just an aggregation of those two.
Great, thanks, Zach. All right, so let's shift a little bit into why all of this private credit consternation really matters. And the Fed recently put out a really great report on counterparty exposure to private credit. And as a lot of people talk about private credit and this, massive asset class that has grown into, maybe 2 trillion in size, the Fed really narrowed their focus into the middle market direct lending type of private credit, which I think is what most people get worried about when they're thinking about potential credit losses and risks. And so the Fed was able to quantify the composition of that private credit investor universe. As you can see here, the pension funds account for about 30% of private credit. Insurance is another big institutional investor, along with investment funds. Individuals account for just less than 10% of private credit assets. And then you have sovereign wealth, nonprofit, and then banks at the end of the list. And as we think about the different linkages that we're monitoring, there's a lot of concerns around what is on life insurance balance sheets, or are banks lending to some of these non-depository financial institutions? Or are there other credit market implications that we should be concerned about? So, Zach, as the head of US investment grade and macro strategy, you have somehow had to become a private credit expert. Why is that? Why should investment grade corporate bond market investors be caring about what's happening in BDCs and private credit?
Well, I think, Winnie, we could pretty much add private credit to the macro remit at this point, certainly at least with how much it's focused on in the media today. But thinking about it a little bit more literally, I think there's been a lot of concern about how private credit becomes a systemic risk to the regulated financial system. And by that, I really just mean the banks and insurance companies. And our banks team has been doing a lot of great work. There's additional disclosure about bank exposure to this asset class. I forget what it was described as more broadly, but now we have non-depository financial institutions, and that's broken out into various subcategories, including business credit intermediaries, which is kind of the best proxy, I think, for private credit and BDCs. So looking at the US banks and the amount of exposure they have, you can see it's grown pretty exponentially, even in just 2025. I think that our analysts would advise that there may have been some recategorization there. And so that's not necessarily organic growth in that last uptick, but you can see that we've more than doubled over the past decade to around 12.8% in terms of overall loan exposure for US banks in our coverage. And so I think that's, the growth rate is certainly worth watching, but I think this overall level of exposure is manageable. And we discussed this at length during our Outlook conference at the end of last year. And I think the big takeaway is having more of this disclosure is helpful. It's worth watching, but we're not terribly concerned about what kind of credit facilities and the amount of credit that banks are extending to the private credit direct lenders themselves at this stage. And I think it's kind of a similar narrative for insurance companies, Winnie, where we've seen a lot of growth over the past decade or so. You can kind of see the purple bar or purple line in the middle there, looking at the amount of US life insurance investment portfolios, how much is allocated to the private market. We've risen to just shy of a third from a little over 1/5 of exposure in these very large portfolios over the past decade. I'd say that our insurance analyst, Josh Estrov, is a little bit more concerned about the concentration of risk to the private credit market in lifers investment portfolios relative to what we're hearing from our banks team and the exposure to the direct lenders there. And so it's certainly something that we're watching, and maybe a little bit more concerned about some of the names that don't have the longer term historical relationships with asset managers that are perhaps a little bit more well versed in underwriting some of this kind of exposure. But in the end, we are comfortable. We do think it's something to continue watching. But when we think about our outlook over the next 12 months, we don't see private credit becoming a big overhang to the overall financial system. We're a little more concerned that you're probably going to realize worse returns in the space than what you've grown accustomed to over the past several years, but not kind of a wipeout of capital in terms of a huge uptick in defaults that becomes a broader financial system risk.
I just also I want to have a clarifying moment on the insurance exposure. Zach, so the insurance private asset exposure, that's not all middle market direct lending. There's other stuff in there too, right?
Yeah, and I mean, and some of it, I think they've increased their exposure to mortgages a fair amount, and I think there's also some much more typical assets like 144As that count as private, but are, really much more like public bonds. And so, you have to dig into the reports. We do a great job of analyzing that. And I think we'll probably be coming out with our update for the 2025 investment portfolio analysis probably in the next month. And so be on the lookout for that. But that's a great clarifying point, Winnie.
All right, so Zach, what about BDCs within the investment grade world? Because they are now issuers, right?
Yeah, there's been a huge uptick in issuance by the BDCs, and so that unsecured issuance has been a big funding source. And I think it's interesting when you look at where this uptick in debt is trading, as we kind of highlight on this table on the right. It's really trading more like a single B name, and so I feel like there's probably some justification to the selling off in some of this as it results to pretty heavy exposure by BDCs to the software space specifically. I think it can be around up to a quarter of overall exposure for these BDCs. However, that spread widening looks pretty attractive. It's a relatively short duration asset class, and so I think that's something to consider. The other thing that I'd highlight is this reconsidering of the future of business models like software. That's probably not done. And the question of who's next, is it likely to be in BDC portfolios, these historically asset light type businesses with strong recurring revenue? I think that risk remains. So you probably want to tread lightly, but we certainly have seen a big uptick in issuance. We see wide spreads there, but probably not quite ready to say that it's a very clear and obvious buying opportunity.
Yeah, it's amazing. Every client meeting I've done lately is definitely trying to identify the BDCs that are the winners and the losers as people are looking for yield and spread within the IG market. BDCs are one of the few places that currently offer it. I want to kind of wrap up the systemic conversation just looking at the leveraged finance ecosystem as a whole. In 2022 and 2023, as Andrew mentioned, private credit really provided a liquidity lifeline to the public markets. They were under some pretty significant pressure from the market volatility associated both with the Russia-Ukraine war and also globally coordinated central bank rate hikes, which was not great for fund flows at the time. And with that, private credit really stepped up to help refinance maturities of issuers that probably were not going to be able to get a deal done at any sort of reasonable level within the public markets, helping to keep a lid on defaults within both the high yield but also the broadly syndicated loan space. Now, more recently, with headlines around first brands, tricolor, private credit stress, default concerns as a whole, we are starting to see again some retail fund flow pressure for the high yield and broadly syndicated loan space. And with that, we do have the question, if the public primary markets slow down a bit, we've seen, I would say, kind of a hurry up and wait type of dynamic within the high yield and loan market since the start of the Iran war. We've had some periods of real quiet in the primary market. And I would say this week has been much busier with a couple of big M&A and LBO deals pricing. But if we continue to see kind of that choppy access to markets, if the private credit market is not necessarily there, that does ask the question, is private credit still a key player of liquidity providing to the broader LevFin ecosystem? So Andrew, I'd be curious to hear from you, what exactly are you hearing about private credit deal flow? Is it done? Is there still demand to put cash to work? Are there any software transactions getting done? How are you thinking about what's going on right now?
So I'll get to that in a second. I just do want to really touch base on the BDCs again. One of the things that's important to watch for is, are there net outflows or net inflows? You have to raise money. You raise money continuously for these perpetual BDCs, and some of that can go to offset some of the redemptions. So if there's a sustained period in which there's net outflows to the BDC, that's not good. Your obviously best credit assets are going to go away before your worst ones. And so
Mhm.
a shrinking BDC is not exactly the best BDC. Obviously, there will be portfolio churn, sort of up and down, but any meaningful drops is not a good scenario. So that's just something to keep in mind as you look at the retail fund flows, the perpetual flows. In terms of private credit deal flow, tech deals are pretty much on ice. those that are getting done at lower valuations. One of the things that you also should be hep to is that it's not necessarily that every single sector is benefiting at the expense of software. Lenders are scrutinizing even like the subdivisions within the broader sector.
Mhm.
In some of those areas, you can have more exposure to AI or at least more AI risk than in other parts of a given sector. And then one of the interesting things has been we're starting to see credit spreads rise. I don't know if you want to call it gapping out. It's really only been up to 50% so far. I'm sorry, up to 50 basis points so far. So you get to the point where you're pretty much priced to perfection as we were beforehand. S450 was pretty much the floor. Now people are saying they're getting deals done at S plus 500. So that's something that's notable. One of the things, though, to keep in mind as you're watching the recent deals print. Um, a good chunk of them were committed to before all of this volatility came out. Give it another maybe like 3, 4 weeks, and then probably all those deals will have closed. So you'll really start to see true new issue deals. Those really reflect what the market is pricing the risk at right now.
I will be very curious to see how that unfolds for sure. We do have a question from the audience around how much retail investment is there in private credit and are there concerns with this growing? I think we kind of alluded to this, but the retail component of private credit is somewhat small, estimated by the Fed as kind of less than 10% of the market overall. Although it does get a little bit messy when you think about, asset managers, how much of that is going into separately managed accounts and things like that. Do we kind of classify that as retail? But it's a relatively low percentage overall. And then I think that the concerns with that growing, with opening up private credit into 401ks and things like that, was just the liquidity mismatch. Private credit is meant to be kind of a long-term locked up type investment. And oftentimes, retail investors will be a little bit more susceptible to uh, selling low, buying high, if you will, in that, they get a little bit worried about when the market is choppy or down, wanting to raise cash. And so that was really kind of the big concern that I understood as it related to private credit expanding into the hands of retail investors. All right, so where do we go from here? What is kind of the next thing that we should be looking at? And Andrew, I'm curious, we've had the direct lending market have spreads tighten up quite significantly. Leverage has increased as there's been this competition for deals. We've expanded private credit through BDCs into the hands of more retail investors, which introduces some liquidity concerns. Do you think that the direct lending market at this point is kind of a victim of its own success?
Kind of. There
Mhm.
have been concerns that have popped up about leverage at these portfolio companies. One of the things that's really important to think about the leverage level, which for context, that's generally one of the quote unquote benefits that direct lenders can offer sponsors, generally a higher leverage level than the public markets. So obviously, more leverage, smaller equity contribution, better returns for the sponsor, but the leverage levels have left concern among some that these interest payments might be really high, and the question becomes, are you able to spend money, when you need to develop products with new AI capabilities or enhance your existing products? If cash flow is limited because of higher leverage, that would be a detriment to the borrower in terms of its ability to adapt. And it's sort of a double-edged sword on the pricing front because it is cheaper for borrowers to afford their capital, when spreads are tight, but also it's a lower yield for the LPs that have invested with the direct lender.
Yeah, and I just also wanted to highlight some of the covenant dynamics within private credit. And I think this is kind of the good news. I feel like we've been a little bit negative on this webinar, which is not usually how I try to convey a message. And the good news is that covenants still exist within private credit. Now, the share of covenant light loans in private credit has increased, looking more like the broadly syndicated loan market, but still not nearly to the very elevated share of covenant light loans. And we have seen some modest erosion in private credit document protection for lenders. But compared to the broadly syndicated loan market, it's still objectively much, much better. And this is actually one of the reasons we think that default rates have been elevated within private credit. Because if you have a stressed issuer that extends a maturity at par, that's still a default in private credit. Whereas in the broadly syndicated loan space, it's often just an amend and extend and not a default event. So you're still recovering at par, but it is that kind of default, which is something that I think is a really important point of focus. And our team at Covenant Review has really been looking deeply at software deals and the covenants within those, because so often kind of the ultimate fate of lender recoveries is going to hinge on what the covenants allow or disallow a company or sponsor to do. So, Andrew, another question for you. We're getting close to the end of our webinar. We have a couple more minutes. If we are entering this period of lower returns, potentially higher defaults, how do you think that the future demand for private credit and BDCs is going to evolve?
So I hate to say this, but I honestly don't know. The question currently is among the retail investors. As we mentioned, they're not a large part of the investor base now, but they have, been a strong growth prospect. So, setting aside that, the vast majority of the investors in private credit are institutional investors. So, in terms of demand for private credit among that group, a lot of these LPs have rejiggered their portfolios over the past, call it 15 years, to include a specific allocation to private credit. So just by looking at it from that perspective, you're still going to see asset managers receive commitments from these LPs because they're required to by the framework that they've developed. Now, obviously, that can change. You've seen people increase allocations to private credit. You've seen some decrease. So fluctuation within there might depend on. Will show you what the demand among private credit investors is. But perhaps one of the other things to keep in mind is how does the performance perform through this cycle? If the LPs are not getting the returns they thought they were getting, then that's, obviously a very good reason to allocate away from the asset class. So the it's a little too early to tell on what it means specifically for private credit and BDCs. But I think this will play an important future in the way that people view the asset class.
Absolutely. The inability to kind of realize those returns as promised, especially when an investor is giving up something, liquidity in order to realize those outsized returns, seems like it's going to be a much more challenging prospect in the near term, given the mix of both macro and micro factors that a lot of private credit issuers and funds are currently facing. Well, that does bring us to the end of this panel. Thank you, Zach and Andrew, for joining me today. Thank you to the audience for listening. My apologies if we did not get to your question. We tried to work through those as much as we could. And thank you so much to the GICP for putting on this broader private credit focused conference. Absolutely very timely. All right, thank you, everyone.